In this edition of INN CEO Talks, I'm joined by Mike Walkinshaw, the CEO and director of Montfort Capital, and we're talking about private credit and the unique investment opportunities it offers. Mike, welcome.
Thank you.
Private credit, a lot of people are going to be completely unfamiliar with that. And of course, they're not going to know your company. Tell us about both your company and then what private credit is and how you have started to create opportunities for investors.
Absolutely. So Montfort Capital owns and manages a series of private credit specialty finance companies. So what that means is we have 4 specific companies that lend money to various different segments of either business or individuals who can't get loans from the banks. So in particular, I'll give one example. Software companies across North America struggle to get financing from banks because banks look at software companies and say, well, you know, there's not a lot of assets there, so how are we going to lend against that company?
You're talking about software as a service kind of companies?
Absolutely,
yeah.
Software as a service companies. And so they, although they are profitable and growing, really struggle to get financing from banks. And as such, their only source of capital has traditionally been angel financing or private equity or venture capital. Why shouldn't they be able to access loans if their companies are reliable and dependable in making these payments, which in that particular circumstance, they really are. So we've built a business around lending money to that particular group of companies with a specialized management team and a specialized credit system, and we do very well in lending to that segment.
What role does that specialized management team play in the relationship that you have with them when they're borrowed money from you?
Right. So having a specialized management team means they're experts in the space. And so they can tell the difference from good and bad. Mm-hmm. That's fundamentally what it means. And that goes all the way down from determining good from bad when you're first looking at a deal that you might want to invest in, put some capital into. It also means that when the company is maybe not doing as well as that you expected it to, that you take actions early and decisively in order to help that company get back on path so that they continue to make payments on your loan through the entire life of the loan.
So what's the advantage to that company, that SaaS or software as a service company, to come to you and get private equity versus private investment?
Yeah. So the slogan we like to use is keep more of your company. Mm-hmm. So that's a slogan we use directed directly at entrepreneurs. So if I'm the entrepreneur of a $2 million per year revenue software company, I have very few options in front of me in terms of growing my business if I need capital to grow my business.
Right.
And so I can go get equity and I can give up 30 or 40% of my company. And then eventually when I sell that company, I have to give the investors who own 30 or 40% of my company that pro rata share of the proceeds. If I use debt, then I don't have to give up that big percentage of my company. And I can grow my business from $2 million a year in revenue to say $10 million a year in revenue. I can then sell that company for $50 or $70 million. And I get to keep the vast majority of those proceeds. From our perspective, we've invested in an asset and an entrepreneur who's very, very reliable. And we have a very high degree of certainty that they're going to pay back our loan over a long period of time. We make the kind of returns we make, which have been sort of 14, 17% per year interest. The entrepreneur is perfectly happy to pay that kind of interest because it's way better than the options that they have in front of them.
But couldn't you make more money if you were following a private investment strategy? So, and I ask that from the perspective of being, let's say, an investor in Montfort.
Yeah.
Wouldn't you have better returns if you were hitting winners by being a private investor?
Yeah. So the first thing about that is when these companies are building themselves up from $2 million to $10 million. If you walk through the door of a venture capital or a private equity firm and you say, my goal is to grow from $2 million to $10 million of revenue, conversation ends right there. Because $10 million, $50 million sales price does not meet the thresholds of most venture capital players. And so while we talk about keep more of your company, the reality of the situation is that the vast majority of the companies that we deal with would never get private equity or venture capital because they don't have enough scale. And what's happening in the software space, what's happening in a lot of these small and medium enterprises that we invest in is they're just getting passed over. So they're not getting the venture capital or private equity, and they're not getting the banking that they need. And so they're left in this desert of financing where they can't find the financing that they need. And so we're the only option in that particular market. Now, you might say, why don't you get more? You could get some options, you could warrants on the underlying company, you could get some bonus payments. You know, I think the service we provide is fairly priced, and we make very good returns in relation to what, say, a venture capital or private equity firm would be making.
So you know you're going to get that percentage, whereas when it comes to an investment, you might.
Yeah, we have
You might not get anything.
You might not get anything, right? So, and the other part of the business that we really like is we get payments every single month. So when the entrepreneur is making a decision between us and equity, if it's available, the equity, generally speaking, doesn't have to get paid out until the very end, although they might make a lot more, or they might make nothing. We get payments every single month.
Tell me a little bit more about your company. Like, when did you start under the structure? As I understand, it was one of the 4 companies that you have now, but you've now expanded it and called it Montfort. Tell us about what happened. What size pool of funds did you start with, and where are you at now?
So 12 months ago, we had $40 million of assets under management. Today, we have north of $450 million of assets.
In 12 months?
In 12 months. And so in the last 12 months, we have acquired 3. We started with 1 company. We have now acquired 3 other specialty lending companies. What we've discovered is that there is a arbitrage opportunity between private specialty finance companies and the public market that we've been able to identify and exploit. So many of your viewers will be familiar with a company called Constellation Software, for example, and their model is, as a public company, go and buy private software companies, put them into the public company, build them up over time, and earn an excess return on that basis. Very much the same model on the specialty lending sector. So there's a whole bunch of small specialty lenders out there across North America who are doing a great job, but are struggling to grow. They might have succession issues. They might have access to capital issues. We solve all those problems as a public company because we're able to bring them under the fold. We're able to give them access to capital that they don't normally have. And we're able to provide succession issues if that's the circumstance, because we're a public company and they can end up buying out of their stock eventually. So
an investor might be looking at you right now going, okay, you've now gone public. Do you have the financial resources that you require to be able to continue to grow at the rates that you have been?
So, yes, across North America, we've been able to access large investor creditors who've given us the capital that we need. And then we layer that on top with access to both preferred shares and common share issuances. And that's one of the big differences between us as a public company and a private credit that's operating in the private enterprise sphere, is we have access to issuing common shares or issuing pref shares that allow us to be able to access and build up our capital resources internally.
So right now, what's the investment opportunity for viewers?
So the investment opportunity for viewers is that I don't think the markets have fully digested the fact that we have gone from $40 to $450 million over the last 12 months. That's the big news story that we're out screaming to the world about today.
You're saying your stock price should be higher based on performance.
The stock price is what it is, but the fact of the matter is we've grown a lot over the last 12 months, and we are in the process of now putting those companies together and creating the operating systems that we need to have internally to be able to operate that big of a pool of assets. It's a tough job, but it's one that we're working on every single day. That said, we are a much larger organization than we were 12 months ago. And I think there's a lot of synergies and benefits that are happening inside there, including access to capital, saving operating costs inside the company. All of these things, shared technology across the platform. All of these things are things that we can access. And we haven't yet realized those benefits, I don't think, in our public stock.
It's a good time to be looking at the company.
I think it's a great time to be looking at the company, yeah, absolutely.
So what's the number one thing that you want viewers to take away from this interview so they get a much clearer sense of where they go in their next query about Montfort?
Well, I think there's really three things that they need to understand. One is that rapid growth curve that we've been on. So familiarize yourself with our financial statements from the last 4 quarters, and you'll see the kind of growth we've been pushing.
The evidence is there.
I think the evidence is there. Number two is the insiders own more than 35% of this company. So we are committed to this company. We are active investors in our own company, and we're very much looking forward to seeing the growth in the stock for our own, as common shareholders kind of benefit. And then I think the third is that private credit is uncorrelated with the public markets generally, and it has a very low level of correlation with the macroeconomic environment. And so while we're going through a time of great change right now, including having interest rates rising, debt is always the thing that gets paid first. So our payments are coming in. As long as we do a good job writing good loans to good companies, we're going to get paid first. It's not an option to make your interest payment on your loan. So our company is relatively stable in times of great uncertainty. Now, as we go through this time of change, I think we're going to see some changes in our business, and we're very active as a management team understanding those and changing what we're doing, changing our underwriting policies and such. But we are the first person to get paid off the income statement of any given company that we're invested in. So there's a high degree of certainty that we're carrying forward with our business model, and it is relatively stable through times of change.
And even more so during times of prosperity.
Yeah, I absolutely think so. And so, one of the things that we see right now, I think that's important for investors to understand is, as banks pull away from the market,
yes,
we actually see higher quality deals than we were seeing 6 or 9 months ago. And that's a very interesting and somewhat unintuitive outcome. But as banks stop lending, they stop giving money to companies that maybe 6 months ago they would have invested in. Now we see that company. So our job as a management team has been to adjust our business and adjust the way we operate so that we are taking advantage of that opportunity and lending into those companies now that maybe wouldn't have been on our doorstep 6 months ago.
Fascinating.
Thank you.
Company, fascinating concept, really unique opportunity.
Yeah, I appreciate that. Thank you.
Well, thanks for coming in and sharing this with me.
I'm happy to, and we'll do it again anytime.
Wonderful.